Should you dollar cost average or wait for accumulation zones? In this video, I'm going to break down which one you should do. And by the way, DCA means dollar cost average, so just to clear that up now. Two strategies, they both work, but which one should you do? Remember, do your own research. This is according to my own research. So what is dollar cost averaging? It's essentially, of course I've got some examples on there, but in short, it's essentially, a fixed amount, a fixed frequency that you stick to, removes emotion, and you can just buy it whenever you like. So let's say, for example, you get paid 10% of your wages goes to the S&P 500, or you go into, Bitcoin or gold or whatever it may be. You buy at whatever price, you don't even think twice about it. Historically, for some assets, it's been very good. The risk you run is if you're dollar cost average into a asset which it could underperform for years, or it could not even make new all-time highs and you could be underwater. Some of the risks you've got to do. So DCA is technically used into very safe assets essentially. So the case for it, as I mentioned, you're always in the market. You're not looking to time things, you're just going to stay in the market. Nothing, nobody times the market consistently. Many studies suggest that. Some people will disagree, but if you're just like an average person who has many things going on in their life, it's going to probably be very hard for you to keep up with markets. So you're almost better off just dollar cost averaging. And it can fit around your life, your full-time job absolutely perfectly. And it builds the habit of investing. It keeps you consistent. It makes you just start investing. So if you're not investing at all, this might be just a great way just to dip your toe in. Just, okay, cool, I'm just going to commit to this amount each month and just see where it takes me. And it might be like a really good habit to start building. So what are accumulation zones? So this could be things like the RSI below 30, Z-score below -2, a set percentage from all-time highs, or all three, combined together. These would be historically, zones that are relatively cheap to its own history. So RSI below 50 is a extremely cheap area. Some people, a Z-score below -2, you'd think it would go back to zero. These type of things. So these are what accumulation zones would be. These would be things you've decided, like an asset is cheap in this. It could be maybe the company's really strong, but the stock's 50% from all-time highs, but it's like Microsoft, for example. Now, I think Bill Ackman tweeted that he's buying, or accumulating some Microsoft because he thinks it's a really strong company and it's really cheap relative to other things in the market. So these are, an investor will say, this is cheap because of this, so I'm going to buy it. That would be an accumulation zone, or a zone to accumulate is probably a better way of phrasing it. A couple of examples here. So we've got the RSI and the Z-score on Bitcoin. Not going to dwell too much time on this, but as you can see here, accumulation zone there on the Z-score would have been a brilliant buy. You've got moments like the RSI going here. It can still go lower. So oversold. Start buying there, and then you've got a massive decline there, right? And then you can also avoid moments like massively oversold conditions there. Okay, I'm going to avoid there. I'm going to avoid there. So you've got zones to avoid with both of these methods. So yeah, these are just some examples on Bitcoin. You've got the S&P, brilliant example there on COVID on both of these. You could have just thought the Z-score down there is a joke, or the RSI down there is a joke. It's like the RSI on 20 on the daily. You could have just, if you had dry powder, which is just basically money on the side, you just almost load the boats. But you do have, zones like here where maybe that wasn't such a good buy. What is interesting actually is the Z-score on the S&P has never gone to this 2 zone where it has gone to oversold. So has the S&P ever been oversold according to the Z-scores? I don't know. Maybe if we were to go further back, obviously it would look like it has done, but in this zone here, very recently it hasn't, which is quite interesting to know. Gold, you would have got some great buy there. That would have been amazing. Same again there, just an incredible buy. Massively over shot Z-score there. That would have been okay, cool, let's take some money off the table. But look, let's buy some gold there. Oh, it's gone down there. So you've got to have rules. These are just some examples. And then look, you've got the dollar. So I just wanted to put this in as well. You can do this for the dollar. Maybe if you're a business and you want to purchase dollars, this could be a reason or a method of doing it. So when would you stop DCAing? So this would be like an accumulation zone method. So let's say, for example, bang, we've got a trigger. We've got a dollar cost average. We're going to buy, and then bang, they cross, we're going to stop. So we've accumulated in all of that zone. You can maybe do a weekly market structure break. So we've got the S&P here, close above that high. So around here, we would accumulate through kind of, let's say, that goes green on the weekly. We just accumulate till there, and then we stop, and then we just maybe hold. So that's it. But the problem you have got is, it's like this can still go lower, and how often do you do it? That's a rule obviously you've got to come up with, but these are some examples of bang, let's start accumulating. We've got all this time, and you could be saying to yourself, I'm confident Bitcoin is going to go back up because of X, Y, Z reason. You've got loads of time to accumulate here. So even if you use all that money you had on the side, your dry powder, you can carry on going, which is really good. So the case for accumulation zones: better entries, bigger positions, more conviction when it matters most. You deploy more capital at better prices. Your risk to reward can significantly improve. Obviously, it doesn't work every time. It's not magic. It forces you to have conviction. So, you'll have to be a bit more active and be watching this a bit more, if you're doing this. But I feel like that's a good habit to have. Like, it all depends what you want to get out of investing, right? But if you want to be a bit more active, but you want a long-term stack, developing something like this could be really good, because you're not just buying, because of the first day of the month. You're buying because your research tells you why you should buy, and the signals are objective, they're not emotional. So you have preset rules to accumulate, which are supposed to be better than just buying every month, because you're not going to buy all-time highs because they don't match your accumulation zones. So those are the reasons why you would do it, but both do have problems. DCA, you could buy at all-time highs. Imagine dollar cost averaging at the top of the dot-com boom. You wouldn't have made any money for a decade, almost, or the top of '08. Oh, I'm just going to keep buying, whatever. If you're a bit more, rotational with your capital, makes more of the argument for accumulation zones. Like, I would never buy here because it's massively oversold, but if you're just blindly DCAing, and also what you do have with DCAing is you can have all-time highs relative to other assets. So I'm dollar cost averaging into this country because I think it's really good. I'm going to do it for 10 years, but those 10 years could be underperformed relative to other countries and other stock markets. So it requires a long-term time horizon to really smooth out. So you've probably got to give yourself a decade at least for DCA, which isn't a bad thing, but you've got to bear that in mind. Like your buy, as I mentioned in the dot-com bubble time, you've got to wait a decade to be actually in profits. That's something you definitely got to consider. Accumulation zones might take years. So this is definitely a problem. You might be waiting on the sidelines for 5 years, and there could be an accumulation zone. Let's say accumulation zone, you don't buy, accumulation zone, and then you don't buy, and it's like you missed out on all that when you could have argued if you were dollar cost averaging, you'd be better. So that's definitely a risky run. And the signal isn't a guarantee, it's not magic. The weekly RSI or the RSI going below 30 doesn't mean it's going to go back up. That's just foolish. So the biggest risk, the biggest takeaway is not being fully allocated. So you've got to think of a way like, do I want a dollar cost average, or do I want to have an accumulation zone period where I am going to be fully allocated? And I wouldn't say you have to be fully allocated, to be honest, but I would say you'd want to probably be like, at least 70-80%, because you probably always do want some there, because you never know, there could be another oversold territory come soon, and then you've got money there. But yeah, I would say you wouldn't want to be 100% if you're doing the accumulation zone method, but to only be 20-30% like that, the tariff crash we had in the stock market, that would be a concern, because you wouldn't be accumulating for absolutely ages. So what assets can you DCA blindly into? So I'll try and have a think of what it could be, or what would be the argument. So gold, it's just been around for so long. You could argue global stock market, just because you're betting on the world to still work. If you're betting in one country, you could have massive outperformance in other places, whereas the global indices, you can chill a bit more, like VT and so on. Things like Bitcoin, individual stocks, they need more, validation. Sector ETFs as well, like you could buy loads of technology, but technology could be really far behind consumer staples or consumer cylinders, is it called? I can't quite remember, I'm not an expert on that. Or you could be buying loads of energy when tech could be the play. So yeah, the less diversified, the more volatile the asset. So the more you need a process first. So you need to have that process first. But if you go to DCA, you need to have fully just conviction. You need to just say, if I was to fall asleep and wake up in 50 years' time, would this be higher? That's basically the question you ask yourself with DCA. So there is no forever trade. I wanted to pull this up there. So the US interest costs will exceed 2.1 trillion in 10 years' time. So the US, so this is almost about the forever trade stuff and like the DCA and into the S&P. Like, is it a good place to accumulate? America has been on a bull market for decades relative to everywhere else. Like, even if I live in America and I'm from the UK, and even like the wages and just like the disposable money, you just feel it from speaking to people. Like, yes, there's obviously people struggling and the K-shaped economy is true, but coming from the UK, it's like, wow, this is kind of crazy. It's like the amount of wealth over here is mental. So has the US gone almost to a point of no return in its sovereign debt? So these are things you've got to consider. If you're investing into a company, you really got to know it. If you're investing in America, you've probably got to be aware of this. If you're investing in Bitcoin, you've got to be aware of, quantum computing or whatever the risks may be, right? So if you're going to invest in something forever, you just got to ask yourself, as I said earlier, can I fall asleep and wake up in 50 years' time and it will be higher? And you've got to have full conviction if you're going to DCA. But just remember, there is no forever trade. Not to say the American stock market's never going to make all-time highs, but it could underperform massively versus the rest of the world. And that time, it could be now, it could not happen. Who knows? But you've got to have conviction. But I thought this would just be interesting to put in, to just put a bit of a different perspective into what you're doing. So look, if you cannot be bothered to make a system, DCA, it works. If you want better returns, develop a process to DCA better, which is within the accumulation zones. So if you want to, if you have the time to do work, do research, it might be a really good way, look into accumulation zones. But if you don't, if you're too busy, just dollar cost average. Just do that. It's easy, it's simple, it fits around your life. You know the score, the system's just you being disciplined to putting your money in every month. You can almost automate it, right? I'm sure you're able to. So that's what you need to do. If you do want to keep up with this sort of stuff, I do run a free newsletter, the Part-Time Trader, so definitely sign up to that. Link to that will be in the description. All the sources referenced here, a lot of it, my own research, my own takes of stuff I've done, but, I've pulled some other data there as well. So, yeah, thank you very much for watching, guys, and I'll see you in the next one.